5-star copies all. Go ahead. Message to observer. Alpha 3 rounds. AT delay in effect. 3 guns. Bravo 2 rounds. 2 guns. Smoke on effect.
Hey, this is Andrew from the Options Man, our YouTube channel. Thanks for watching. Today we're going to be talking about the VIX. The VIX is a topic that is highly contested, highly discussed across all investment communities. There's a lot of great information out there and unfortunately a lot of misinformation about the VIX, and today I'm going to do my best to clarify what is right and what is wrong about what you've heard. But first, a little history behind the VIX. Where did the VIX come from? How did it start? Well, the VIX originally was designed in 1993 by CBOE to measure the S&P 100 index on the market's expectation of 30-day volatility. In addition to 1993, the SPX was only measuring S&P at the money positions. It quickly became a very widespread, accepted way to measure market volatility. 10 years later, in 2003, they updated to a new VIX. This VIX now tracked the S&P 500, not the 100, and instead of only tracking S&P at the money positions, it aggregated the weighted price of the S&P index puts and calls over a very wide range of strike prices. This made it a much more robust and accurate way to measure implied volatility for the 30-day mark. And more importantly, it made this a much more practical method on which to track and analyze hedging volatility amongst the larger institutions or overall larger players. So now that you know a little bit about the history, what is the actual VIX that we know of today? I'm sure you've heard 1,000 times over the internet that the VIX is called the fear index. Although that's a very flashy way to describe it, it's not necessarily a measure of fear. So if it's not the fear index, what is it and what does it actually measure? Well, the VIX index is a calculation designed to produce a measure of constant 30-day expected volatility of the U.S. stock market derived from real-time mid-quote prices of the S&P 500 index call and put options. The VIX is able to track these price adjustments through the application of a very complex equation. Now, we're not going to get into the equation or what it means or even try to calculate it, but for my math geeks, here's what it looks like.
Check out the big brain on Brad.
So what does the VIX mean to you, the average retail trader that wants to become a little bit more consistent? Well, let's take a look at the VIX chart. This is the daily chart on the VIX. You'll notice that predominantly the VIX points down, with every now and then we'll see these very large swings that quickly get rolled back over. And since the beginning, the VIX has pretty much stayed in a range of about 9, with the highest spike up into the 80s in periods of severe volatility like the 2020 coronavirus crash. In a nutshell, you need to know that whenever the VIX spikes, that is showing that there's major positioning for hedging to protect one's portfolio against downside on the institutional scale, not necessarily the retail scale. When the larger players or institutions are beginning to pile into downside protection for fear of the market dropping over, the VIX tends to start climbing. The more aggressive the protection, the harder the VIX rises. And that's, in a nutshell, what you need to know. A lot of people incorrectly assume that the VIX and the S&P are permanently inversely related, meaning when the VIX goes up, the S&P goes down. When the S&P goes up, the VIX goes down. Although, for the most part, that is usually what happens, but that is not necessarily always the case, and it doesn't always happen that way. For instance, during periods of very low IV or low volatility, the VIX very well may begin to climb alongside the S&P. This is usually in periods where there's simply no more positions to roll off, no more hedges to roll off, and institutions are beginning to start putting on positions simply because put premium is so cheap that it's one's best interest to start protecting their portfolio against any kind of downside, whether it be expected or unexpected. Now, what products can you trade with the VIX? Well, there are VIX options. If you actually put in the VIX into your broker, you'll see an option chain pop up, and you can trade options on the VIX. Although I will caution you, trading options on the VIX are a lot more difficult than trading options on, let's say, SPY or SPX or any other name. Now, you can also trade VIX futures, which has the ticker VX. Now, VIX futures reflect the market's estimate of the value of the VIX index on various expiration dates in the future, hence the name futures. Trading VIX futures also allow you to trade a different strategy with the VIX, increase your level of risk management, and generate some alpha. And now you know what the VIX is and what VIX futures are, we could talk a little bit about something called Contango and Backwardation. If you are a future trader, or maybe if you're not a future trader, futures products trade at a premium of their current spot price because they are forward-looking. Hence why, if you go look right now, ES futures are at a much higher price than the SPX price because they are forward-looking. And as you get closer to the expiration, they usually close at the spot. So the delta between the ES futures and the SPX spot price will close as you get closer to the expiration. And that leads me to describe what Contango is and what backwardation is. Normally, we are in a Contango market, meaning that the forward prices of the VIX futures are higher or at a premium relative to the VIX index. If you were to graph it, it would look like this. You see the graph is pointing higher and higher as you get closer to expiration, meaning that the forward pricing of the VIX futures are higher than the spot of the VIX. Now, this is pricing in a, I guess you could say, bullish picture of the forward-looking market, assuming that the VIX is going to stay low and the VIX futures are going to stay higher until it closes at the spot. This is normally surrounded by periods of lower volatility, lower bearish thesis, and not much expectation for any kind of significant drop in the markets. Now, conversely, we have what's called backwardation. And backwardation, this is where the spot price is higher than the futures pricing. This is what the chart looks like. Look at the difference between the Contango chart and the backwardation chart. This is usually a signal for fear in the market because it means traders are expecting elevated volatility in the near future and are beginning to price that into the market by adding protection on the VIX, which increases the prices of the VIX, which then allows the spot to climb beyond the pricing of the VIX futures. Usually you experience a lot of periods of backwardation during periods of elevated volatility and tumultuous times in the market. For instance, a great example would have been the 2020 market crash of coronavirus, where we saw an incredibly high levels in the VIX and put the market into backwardation. But that's the VIX in a nutshell. I hope this has helped you and answered a lot of different questions. I do have another video that's more of an application style video I made a couple years ago. That's me actively using it to enter trades. And click on that video up here in the corner if you'd like to watch that one as well. If you have any further questions about the VIX, or if there's something I didn't cover you'd like to know, or you can hit me up on any of my social medias, all links down in the description of the video as well. Come check us out in the Discord. We stream every single morning and have discussions about market theory, concepts of trading, and risk management. I appreciate you taking the time to watch this video. Until next time, I'm Andrew with the Options Millionaire Community, and I'm out.